Everyone in Canada celebrated. The Bank of Canada took the overnight rate from 5% all the way down to 2.25%, the deepest cutting cycle most of us will ever live through. So you did the sensible thing. You watched the headlines, you waited for the relief, and you walked into your branch to renew. And the offer on the table was 4.5%, roughly double the number the bank keeps announcing from Ottawa. So why is the relief staying stuck at the top? Why does the cut show up on the news, but never on your bank app? And why does your payment still feel like climbing a mountain 5 years after you signed the cheapest mortgage of your life? You have been watching the wrong number. There is not one Canadian interest rate, there are two, and they answer to completely different masters. The first is the overnight rate. That is the Bank of Canada's rate, and it flows straight into prime, which right now sits at 4.45%. Prime is what your variable mortgage, line of credit, and HELOC are priced off. And when the bank moves, prime moves within a day. That tap really is controlled from Ottawa. The second rate is the one most Canadians actually use. About 3/4 of mortgage holders here carry a fixed rate, and the 5-year fixed is the default. It is not priced off the overnight rate at all. It is priced off the yield on the 5-year Government of Canada bond, and nobody in Ottawa controls that. That yield is set every day by a global auction. Pension funds in Amsterdam, insurers in Tokyo, and above all the gravitational pull of the United States Treasury market. Those buyers are not asking what the BOC did last Wednesday. They are asking one question: what will inflation average over the next 5 years? Right now, that yield sits near 3.1%. Add the lender's markup, and you get today's fixed rates. That is the entire mechanism. Picture the machine like this. The Bank of Canada has its hand on the first gear. That gear is the overnight rate, and it turns exactly as far as the bank decides. Your mortgage is the second gear. Between them, there is a belt, and that belt is loose. For 2 years, the bank spun that first gear hard. For a while, the belt gripped. Variable rates fell. Prime came down. But the second gear has another belt running to it, out to the global bond market, to oil prices, to American yields, to inflation expectations. And in 2026, that belt is pulling the other way. Oil is up on Middle East conflict. American Treasury yields have risen. Canadian yields have not fallen. So the first gear spins, and the second barely moves. Some weeks it turns backwards. That is the whole story of this year. The bank has held at 2.25% for 6 consecutive decisions, and over those same months, 5-year fixed rates have drifted up, not down. The bank is not lying to you. It is simply not connected to you the way you assumed. Now here is why a cut feels like an insult rather than a gift. When your renewal letter arrives, you are not comparing today's rate to last year's. You are comparing it to the rate you signed in 2021, and that was not normal. It was the cheapest money in Canadian history. Take a household in the GTA or the Lower Mainland. $500,000 mortgage, 25-year amortization, signed at 1.5%. That payment was almost exactly $2,000 a month, and the interest portion in year 1 came to roughly $7,400. 5 years on, they have paid the balance down to about $414,000. Real progress. Then they renew at 4.5% across the 20 years remaining. The new payment is roughly $2,620 a month and $620 more every month for the entire term. But the interest line is what stings. In year 1 of the new term, interest costs about $18,300, nearly triple the interest on a smaller loan. And this is not a small group. More than 1 million Canadian mortgages renew around the middle of this year, nearly all signed when the policy rate was at or below 1%. CMHC and the Bank of Canada estimate roughly 60% of those households are seeing payments rise, with 5-year fixed borrowers absorbing increases of 15 to 20%. A cut does not undo that. It only makes the fall slightly less far. And there is a second layer. The bond yield is the floor. It is not the price. TD Bank, Royal Bank, Scotiabank, all of them buy money at roughly the bond yield and sell it to you at a markup. That markup is the spread, and it is not fixed. Historically, it ran around 1.25 to 1.5 percentage points. When lenders get nervous, it widens. And they are nervous. Unemployment has been sitting between 6.5 and 7%. Growth this year is projected near 0.7%. Arrears are quietly climbing off historic lows. That nervousness has a name: the risk premium, the extra margin a lender charges against the possibility that some borrowers will not pay. When the economy softens, That premium rises and swallows the cut before it reaches your renewal letter. There is also a blunter reason. Banks answer to shareholders. If a lender holds its rate steady while its own funding costs fall, that gap is pure margin, funded by the customer who does not shop around. A rate cut is an opportunity for the bank. It only becomes a discount for you if you ask. So, why will the bond market not let long-term rates fall? Because it does not believe the inflation fight is finished. The headline number looks respectable, but the bond market does not buy headlines. It buys components, and the sticky components are services and food. Restaurant bills, insurance premiums, property taxes. None of those fall when the bank cuts. They fall when wages cool, and wages have not cooled. Every Canadian carries a private inflation index in their pocket. The receipt from Loblaws? StatCan can publish a number near 2%, and that receipt still tells a different story, month after month. Add an oil shock out of the Middle East, and the conclusion is simple. Canadian inflation may not be dead. It may only be sleeping. So they demand compensation. They refuse to buy 5-year Canadian debt below roughly 3%. And that refusal, not any decision made in Ottawa, is what sets your fixed mortgage rate. Tiff Macklem can hold a press conference. He cannot hold a vote in the bond market. You know the feeling. Any quiet morning, at the start of the work week, you open your phone. A headline about the Bank of Canada. A cut, a hold, a hint. You feel that small flicker of hope. Then you open your banking app, and the math has not moved at all. Same balance, same payment, same date. That gap between the news cycle and your actual life is not a mistake. It is structural. The news reports the first gear. You live on the second. Which leaves the question every Canadian renewing this year has to answer. Variable or fixed? Variable today, prices near 3.45%. Prime less, a discount of around 1 percentage point. Fixed sits near 4% on the sharpest insured offers, closer to 4.5% for many uninsured borrowers. Variable is the elevator. It moves with the Bank of Canada immediately in both directions. If the economy stalls and the bank cuts again, you ride down at once. But the Governing Council has signaled the easing cycle is over, and several major forecasters think the next move is more likely up than down. An elevator goes both ways. Fixed is the stairs. Slower, more expensive today, but you know exactly which step you are standing on for 5 years. There is no universal answer, only a personal one. If your payment rose by $400 next quarter, would that be annoying, or would it be a crisis? If it is annoying, variable is a defensible bet. If it is a crisis, you are not buying a rate, you are buying certainty, and certainty is worth paying for. And do not ignore the middle of the curve. The 3-year fixed is the cheapest point on the ladder right now, near 3.8%, and it puts you back in the market in 2029. Here is the uncomfortable truth. Interest rates are a blunt instrument, not a precision tool. The Bank of Canada has one lever, and it is using that lever to manage a $3 trillion economy. Grocery prices, oil shocks, trade negotiations, a soft labor market. It was never designed to fix your mortgage. It was never designed to see you at all. Which means waiting for a rate rescue is not a strategy. It is a hope outsourced to a committee that does not know your name. The Canadians who come out of this decade in good shape are not the ones who timed the bottom. They are the ones who stopped waiting and started building a debt fortress. That means shopping your renewal instead of signing the branch offer. The stress test change from 2024 lets you switch lenders without requalifying, and that single phone call is worth more than any cut. It means prepaying while rates are moderate. It means holding your payment steady when the rate falls, because the difference goes straight to the balance. None of that requires permission, and none of it requires a forecast. Because true financial freedom in Canada is not a low interest rate. True financial freedom is the day your life stops, depending on a press release from Ottawa. If you learned something from this video, like and hit subscribe. We'll see you in the next one.